right, traders, it's Monday, the 9th of October, and we have a lot to get through here today. And this week is going to be an interesting ride. So, just having a quick look at the data calendar, tier one events only listed here. So, you got German CPIs coming through Wednesday that to come out point 0.3 prior point 0.3. Not huge expectations for anything to go on there. The DAX is obviously going to be driven around the place by this Israeli situation and indeed what will happen in the S&P more so. Then US PPIs half one Wednesday. You get DOE in there. Actually, you'll get DOE, sorry, Thursday. And then FOMC minutes this Wednesday, quite important. Then Thursday, core CPIs and CPIs for the US, initial jobless claims and crude oil. There you go, 4 o'clock, because today is Columbus Day in the US. Little quieter, yeah, we've spiked up a gap on oil, but actually it's a little tamer than I would have expected. And this may be because we have Columbus Day in the US. We'll get a look at that chart in a minute. But like straight into it here, we have Hamas bombing Israel and Israel counter bombing the Gaza Strip and what is known as the largest open air prison in the world at the moment, containing Palestinians here in the Gaza Strip. So you can see from the legend that the Hamas rocket fires are these red circles towards Tel Aviv. And gun battles then breaking out all along the Israeli side of the Gaza border. This started at around 3:30 a.m. GMT on Saturday, I think it was, as we're now in the third day of conflict here. So there's no end to the amount of punditry comments on this, and I don't think my input is going to be the most valuable, but I'm really looking at this through the lens of the markets and from a trading perspective. So let's kind of get through some of the impacts that we're going to see here. Obviously, oil is crazy bid, and I think this comes at a really bad time for oil. Good for oil traders, but basically we have OPEC cutting all the way up to this now happening. I've tweeted over the weekend that the US has about 326 million barrels of oil in the SPR, the Special Petroleum Reserve, and that equates to a total of 17 days of supply for the US, or 17 days of consumption, I should say, for North America. So that, this is really coming at a bad time for the US. So let's kind of get further into this now. Obviously, the US are responding to this. So they are the big brother for Israel, and they're sending a fighter carrier to the area, to the Mediterranean, to look at this. So I'm going to post links to these articles here. So yeah, I mean, I'm not up to the minute on whether Israel is going to now attempt ground invasion of Gaza or Lebanon, but I can tell you one thing, that if they do attempt a ground invasion of both or one of those places, this is going to be World War III proper within 12 hours. You're going to have Russians responding. You're going to have Saudi making clear their stance with or against the US. Iran is going to be pulled into this. And then China are going to have to pass comments if there is a ground invasion from Israel into either Lebanon or Gaza. Yeah, I mean, what can we say here? It's just, this is an absolute shit show for everybody involved in the ground. Make no mistake, as traders, we do care. Absolutely, we care. But our job is to also take advantage of market pricing and mispricing when these things happen. Have a read of this because it's quite a detailed article from Bloomberg, highlighting areas of attack and counterattack along the Gaza Strip and indeed in Israel. up in, you don't see it on this map, but there are a lot of Irish, I'll show it on the next map. There are a lot of Irish peacekeeping soldiers in South Lebanon at the Golan Heights, where it borders with Israel, who will be on super high alert now, as you can imagine. Looking at the area that we're dealing with here, guys. Okay, so there's going to be a lot. There is already a lot of reference back to the Yom Kippur War, in '74, I think it is. We're gonna, when was it? 73. And back then, really, the dispute really kind of was focused on the Sinai Peninsula here, and what Egypt wanted to do is essentially secure their access to what is the Suez Canal here, a really key shipping conduit here, for global goods, essentially coming from Asia into Europe and North Africa. So EMEA whole here, essentially into Turkey. So the Suez Canal, incredibly important here. Okay, so if you're not familiar with your geography, here is the Gaza Strip and Israel and Tel Aviv just up here. Okay, now the other really important choke point for goods and for mainly oil, where I think 70% of the world's oil passes through this area here in the Gulf of Oman. It's the Straits of Hormuz. Now, we haven't really heard of anything in terms of Iran trying to shut this down or anyone trying to shut down access to the Straits of Hormuz here. But we are on the footsteps of, that being a breaking news headline. Okay. And if that happens, you are going to see $10 up on oil easily. So that's going to be 96, back to 96 WTI. It's going to be, I don't know where we are on Brent at the moment, but add $10 onto it. Okay. So that's kind of the geography of what we're dealing with here, guys. Okay, so you have been warned here about where everything is. So the Sinai Peninsula, that's what was going on, and control thereof the Suez Canal was what was really the focus of the Yom Kippur War. That led to the oil embargo shock, where OPEC essentially cut. I can't remember the exact details, but um, OPEC essentially cut a huge amount of oil production at that time and banned exports to the US, and then threw in a couple of European countries into that export ban as well at the time. And then, of course, we had a huge spike in oil prices. And really, the consolidation and the birth of OPEC kind of came out of that. Okay, so this is a very big Wikipedia article here on the Yom Kippur War, but it's good to get the broad strokes of what happened then, to know your history about this, and about what could come. So, the 1973 oil crisis, for one, if we just look at the charts here, adjusted for inflation, you can see what happened to oil at the time. Okay, we went from inflation adjusted. We went from just around $35 to $140, and that is inflation adjusted here. This is crazy. The nominal was okay. The nominal was about $12 up to about $40 through that crisis. Okay, so really crazy. And you can see it's a long sustained bid in oil, because that the world was waking up to essentially the Middle East flexing its muscles and flexing its importance, to do with access to oil at the time. And so that's why it was a long sustained price bid into oil. Okay, so moving quickly through here. Israel is now ordering the shutdown of key gas fields over this conflict. Okay, so there's not a crazy amount of oil coming, or sorry, gas coming out of Israel at the moment. But there you go. Egypt aiming to boost LNG exports, but not until 2025. So this is really going to put a lot more pressure onto your Henry Hub LNG NG futures contract, as in good old US nat gas. Okay. Now you're seeing there's really, I just don't ever think about Israel as oil or gas production and it being that significant. And I think there's a lot of exploration and development going on over the past 5 years, 10 years there, but they're not mature fields. Okay, so before I come off at this point here, before I come off this conflict point, I think what we've seen is a knee-jerk reaction down, which has been rebought on equities from the reopen last night. So downside and then upside. Oil, obviously, huge gap up there to, I think we opened at about 85.26 from a close of 82.83s. Currently trading actually not too far up. I mean, we're positive here about 4% on the day on WTI, trading 86.09s. But what does this mean for equities? Well, it means a ton of volatility to the upside, to the downside. I think to the downside for the moment until we get further development of how this situation is going to unfold. Whether how strongly does Netanyahu want to respond? Does he want a ground invasion of Gaza? If he does, this is going to be negative for equities. I think equities are waiting to get back to business as usual. However, the kind of the not so outlier event now is that this turns into a full on global conflict and World War III proper, in that this becomes a sort of a nexus point for the US to say, oh, all right, we've been putting up with the Russian invasion of Ukraine, but we're not going to put up with, you know, Iranian interests basically taking a shot at Israel. And sure, Iran will deny that they have no involvement with Hamas. Hamas have taken responsibility for this, obviously. Um, but the US aren't going to wear that, and they've invaded for less. So I think this is an incredibly dynamic situation that it's really hard to take a position in the markets over this. So I'll be probably doing something ad hoc during the week as a video release, and I do have a chat with Jason that I recorded after we saw this invasion to release here as well. All right, so back to other markets here. Um, on the bond situation, which is really what we were talking about before this Israeli situation, you're seeing, these bond yields screaming to the upside, and this is really now pushed emerging markets to the brink. So you're seeing that a lot of these emerging markets have sovereign bonds that are kind of pegged to the dollar and where the US 10-year yield is at. And they would be trading at maybe 50 to 100 basis points over the US 10-year. In some cases, you see 1,000 basis point premium to treasuries, US treasuries, right? So looking at this, the first that may fall here in bond default risk is looking like Ethiopia. Okay, where their yields are at. Then you're looking at Tunisia, Pakistan. Actually, a friend of mine was asking me about Tunisian bonds recently, and I hope he didn't get in there, but I think I brought him to his senses. Pakistan and then Kenya looking probably the best here for out of the lot. Really interesting article. And you could see a lot of sovereign defaults in these emerging markets coming over the next 4 weeks. I think with this war situation, which I did talk about being a bid scenario for bonds, which would lower the yields. I did talk about this to Jason, and I said this won't be one way for the US to kind of escape its mounting coupon repayment responsibilities on the amount of debt that they're issuing, i.e., their bonds. But that's a talk for another day. But do have a read of this, because I think this will be more and more important over the next 10 trading sessions. But obviously, at the forefront of the news cycle right now is this Israeli situation. All right, on to oil. Oil surges on the Israeli conflict. Yeah, everyone knows get into oil, get long, try and stay long. What we do see, though, with these sort of situations We saw it with the US going in on the Gulf War. We've seen this with when Saddam Hussein started invading his neighbors. The bid scenario quickly gets priced in to the point where if you're long and holding long oil on, simply because you're on the main news cycle that Israel is getting hammered by Hamas, um, the oil shock can get priced in pretty quickly, and you could find yourself weathering some losses if you don't already have really good long oil pricing on your trade. So what I'm saying is, essentially, oil could easily just take a pullback to the downside, close the gap of about $2, $4 there, and then the trade gets going to the upside. Okay. So, again, I talked about this last week. If you're in the day trading environment, you gotta, when you're on side a nice amount, you gotta bank some gains, size down a little bit, make it a green day, make it a green couple of days, and then that'll afford you to scale back into the trade should you need to, or if you want to, even, right? But yeah, I mean, I've been trading oil for maybe 15 years, and I can't actually remember as perfect a bullish picture as the one we have right now. So as I said at the top of this recording, that OPEC have been cutting production all the way up to this point. Some people thought they were going to add production back on at the last meeting we had there, 2 weeks ago? Maybe it was last week. And no, they're not going to. Essentially, the global picture is tight. It is really tight on supply. As I said, the US have 17 days worth of supply and storage. And if this situation kicks off, they're going to need a lot more than 17 days of of indigenous spare capacity. All right, so kind of talked about that enough. The other thing that is bubbling away in the background is this. Now, you're probably thinking, well, we're not really interested in talking about this, Tim. Israel is the big hot ticket right now, but I've talked about that, and the markets have kind of settled on that for the moment, and the markets are firmly waiting for the next sort of phase and wave of how this conflict is going to take shape. Look, conflict in the Middle East is it's kind of like blades of grass. It's just to be expected, and lots of them, right? But this is quite a bit different, and it's not just because it's kind of well timed with the 50-year anniversary on the Yom Kippur War or any of that. But well, look, we'll just leave it there. Look, this is kind of interesting. VCs bracing for a new wave of global ESG rules. So what I've been seeing, and I am sort of half involved in an ESG sort of project at the moment personally, is that the markets are waking up to the reality of ESG investments, in that the curve, the return curve on those investments looks like this, as in down. Okay. It does not look like this. And so a lot of these investors, funds, banks, etc., corps, are all waking up to, what? There's a lot of greenwashing going on with these funds. A lot of these ESG funds have things like Google, Nvidia, BP, Shell crammed as big constituents in these funds. Now, you can understand from the point of view of big oil companies that have huge investments in carbon capture, in transitioning, in and actual active investments in wind and solar technology, and some mergers and acquisitions in those areas. You can understand why those companies will be in ESG funds, because they are putting to work a large amount of money in those areas. Obviously, Shell has cut their ESG activities because they couldn't find good enough projects that would clear due diligence. But that's a different discussion that I talked about in the room in the Discord and Duggan Capital a few times. But the point is here is that things aren't looking good for ESG at the moment. Okay, so have a read of this, because essentially there's going to be a big shakeup here, and I think it's going to cause a lot of reallocation of funds. And I think in this world where, liquidity is kind of getting tighter on these higher bond yields, it's going to be more and more difficult for portfolio managers and VCs and fund managers to get access to capital. They might have capital committed, but that means the money is still in their investors' bank account, waiting to be transferred once the portfolio manager or the VC lead finds a project that they want to put the money in. Then they have to jump another hurdle to actually get the money invested. Money committed is not money in the VC's bank account. It's money in the investor's bank account waiting to go to the VC to then go to the company. Okay. There's two things here. Number one, these VCs are going to be really questioned now as to how ESG their investments are. Do they clear Article 6, 7, 8, 9 of the Paris Agreement? But the other thing is that the hurdle rate, the return, the amount that these guys need to return to be above the risk-free rate, right? So what I mean is that if the yields on the bonds, which is the risk-free rate on 10-year, is like, say it's like 4.8%. Let's just say it's 5%, all right? If the risk-free rate is 5%, okay, and these fund managers have been dicking around giving returns of 6%, the investors in the VC funds are going to be like, you know what? Why do I even bother with you guys if it's 6% and I'm adopting a ton of risk when I could get the risk-free rate at 5%? I think it's more like 4.8 at the moment, but you can understand what I'm saying, right? So these VCs have to be looking at like 12%. Before, it probably would have been about 12% they were looking to return, okay? But now, if the risk-free rate is at 5, that's going to put their 12% up. It's like 17% returns. So the hurdle rate for these guys to return well far and above the risk-free is now getting bigger and bigger and bigger. And so it's putting way more pressure on the performance of all these funds, VCs, ESG funds, you name it, all these guys. So I think there's a bit of a reckoning to come here, and I think the tide's going out. It feels like the tide's going out, right? All right, let's here's an article from Barclays just speaking a little bit more about these ESG fund flows getting hit simply because of the rise on the yields is going crazy and liquidity is drying up, and all these limited partners that would normally put their money into VCs that would then put it into ESG funds. All these investors are saying, "Hey, there's some better looking stuff and more risk free stuff over here. I think I'll just go and invest in that, and I'll come back to you guys later when the yields on the bonds aren't so good, right? When's that going to be? Not for a long time, not for a long time at all, guys. So, that's just one thing to look out for. I'll post these links. There's another good article here from The Economist back in September last year that kind of looks at this, and it kind of, will kind of, let you kind of see through what type of returns that these projects, I think I saw the word giddy there, and I think the world has been giddy to get in on ESG, tick a couple of boxes, and then forget about it and try and raise some carbon credits and sell those. But as I said, the tide's going out, and the boats are sinking, I think. I don't dabble too much in zero hedge. It is kind of market traders porn, if you like. But now, okay, so Israel now striking targets in South Lebanon. And my thoughts and feelings and prayers do go out to the Irish soldiers who are there in South Lebanon trying to keep the peace. And I don't know what's going to happen to those guys now, but they're going to be in the middle of it. Okay, another thing here, the shekel stabilizing. So I'll kick over to the Israeli shekel chart here, and you can see on the monthly bars on the left. We kind of hit this mega downtrend from the all-time high in May 2012. intersected in March 2015, and that's where we hit on the top here, right? On the right hand side, you're looking at the 5 minute chart of the Israeli shekel. So this is kind of where we really topped out, and you could see by about yeah, on the reopen of trade last night, GMT 2300 hours, you could see that we had that hot flush above, and then once it kind of turned to about 10 to midnight, we just could not get above there, and we just started to crash back down. And we're kind of in the upper range of this opening, crazy opening rebid here, um which happened here at Sunday 2100 GMT. I think the Israeli shekel does trade 24/7 actually. I know Israeli markets are open on Sundays, but it just give you a little flavor of what actually happened there on the currency. All right, moving back. Um, or sorry, hold on. I'll just transition. Yeah, okay, here back we go on to the news items here. Um, what else? Yeah, visualizing the pyramid of financial risk. We're not going to talk about this too much. Actually, we're not going to talk about this at all here. Um, so yeah, look, that's where we are on these markets right now. Um, I think looking across the broader picture of these markets, you're seeing Nasdaq in the middle, SPOOs, or sorry, Nasdaq on the left, middle, SPOOs in the middle, Dow on the right. So you're seeing you got these big gap downs there. Like if we just look at the S&P, for example, you're seeing this big gap down at the close there on Friday, reopening just around here, reopen around 33.15s. We're just closing that gap here basically in this little area in blue. We're just closed that gap in the last auction there. So it's going to be interesting to see what we can do. Now, I mean, looking at the daily bars of this, to me, we saw an incredible big come in on the S&P there on Friday on that NFP beat 356, I think it was, over what, 170. Really good bid, but that doesn't really mean that we're out of trouble here. But let's see what we can get. I think the test on 43.77s is going to be interesting. And if we do test up on the 44.90s, I think we're going to run into a bit of a demon up there, same way we did on oil before we took this pullback that we've had for the last couple of weeks on oil, which is not going to be sustained now that we're bid in this environment. Looking at the bond yields as well, you see the bund here, and the bund just on the front foot all day long there. It's German 10-year, and then T-notes trying to claw its way essentially out of these lows, right? And so, it should do. I mean, this is what I said to Jason. Any war risk situation, we're going to be back up and the yields will start to dissipate back down. So that's what you're getting on the 10-year right now. The yen is bid. Dollar, not really so bid, guys, here, I mean, and that really speaks to where the dollar is at the moment. I think there just is a certain level of not interested in the market, like from the market point of view. I think the market just kind of doesn't want the risk. It doesn't think the dollar is that much of a de-risk element of a portfolio now. The market's going to want to look at the Swissy, the yen, the Aussie dollar. They don't want to really get involved in this Dixie here at the moment. You're seeing this lovely, like very aggressive up channel here on the dollar, really since July there of this year. Are we going to break this sort of, this is like a mega bear flag essentially? Are we going to hold 106.07s? If we can't, well, you can tell which way this is going to go. Now, I don't want to get into the scenario where the dollar does that, to be honest. Gold, again, gap up here on gold. Let's just get the big chart up on gold and do this. Yeah, so we're coming out of what was the low there last week, 1823s. We're retesting 1864s here. We were kind of trading 1864s around February this year. Massive bid came in there. From that point, it was a huge day on gold there. Yes, 2023. Sorry, this was April. Okay, no, I'm gonna have to fix this data on my gold chart. But either which way, yeah, look, gold's gonna be bid. But it's going to find it harder and harder if if bonds keep on the bid as well. So do watch out for that. And then, Big Daddy Oil. Where are we going to? Well, we've got this lovely gap up here. YP Val coming in 81, 84s on Friday. I thought maybe we could have stayed another day around there, but obviously we've got this risk scenario for supply. So where do I think we're going on oil? Well, that is all dependent on what happens and what is the next phase of this conflict. Now, if there isn't another phase where things don't ramp up and the US uh, Navy ships in the Eastern Mediterranean is enough to calm everybody's jets, well, I think oil's just going to, come back down. We're probably going to trade 83s within probably 5 sessions, and we'll just have a blow top here at the moment. There's a kind of an anatomy to these situations on oil where a huge amount of dumb money comes in and is just buying, buying, buying on the open, and you're seeing the excess there on the lows we pushed up on oil here on the open. But then they just stay in the trade too long and they don't get out. And then the smarter traders will be getting out, on what 1-2 points back up here, maybe three. But if you don't get out of that trade, you're going to be wearing a lot of P&L pullback on your face there. And so you got to be quick and nimble to book it, and then leave the runners on for the swing. Yeah. Or be willing to buy something back into the gap close here. So that's kind of where we are on oil. All right. This big red area being the gap. It's 82, 88 up to 82, 85, sorry, 25s. All right. So that's it for me for this week for a look ahead. Listen, guys, please click to like and subscribe. It really mean a lot. Hit that notification button. We're only releasing these once a week. It's not a big deal. But hopefully it's useful to you as traders out there. Going to be releasing a new interview with Jason. We had a bit of a chat there on Saturday night. Saturday night, yeah. So listen, be safe out there and keep that wrist tight. Take it easy.
Uh-huh.